यूएस मार्केट में इन्वेस्ट करके डॉलर्स में कमाना चाहते हो पर हाई टैक्सेस से डरते हो? Well, you're not alone. Every one of us is attracted to the US market, but the tax system for Indian investors is quite complicated. Therefore, in this video, we will discuss tax implications on the US investments for Indian investors. Let's first discuss the tax implications on assets. Now, tax is levied on different types of income. First up is capital gains tax, which means you have to pay taxes on the profit you made from an investment. If you held the asset for less than 24 months, you need to pay STCG or short-term capital gains tax as per your income tax slab in India, which means if as per the income tax slab, your tax liability is 5%, then STCG tax will also be 5%. Whereas, if you held the asset for more than 24 months, you need to pay a fixed 12.5% LTCG or long-term capital gains tax. The good part is you don't have to pay anything to the US government for your capital gains because of the Double Tax Avoidance Agreement or DTAA. We will be discussing this further in the next section of this video. Second is dividend tax. Now, when you invest in the US markets and get some returns in the form of dividends, you will have to pay 25% as withholding tax to the US government. And this is by default, which means your account gets credited with the after-tax dividend or 75% of the total dividend earnings. But the Indian government also levies dividend tax as per the income tax bracket. So does it mean that you will have to pay the taxes twice? No, because there's an agreement signed by the US and India. That is DTAA or the Double Tax Avoidance Agreement. Using this, as an Indian investor, you can claim a foreign tax credit and offset it against your tax liability in India. Long story short, the DTAA ensures that you pay dividend tax only once. Capital loss offsetting. Now, while investing, there will be times when you will make losses. Imagine you held an asset for less than 24 months and made a loss on it. It will come under short-term losses, which can be used to offset the tax liability on the long-term or short-term capital gains. Similarly, if you held an asset for more than 24 months and made a loss on it, it will come under long-term losses, which can be used to offset the tax liability on the long-term capital gains.
Now let's move on to the tax implications of remittances.
When you, an Indian investor, send money to the US to invest in US assets,
It's called remittances.
from a general point of view, transfer of money from Indian to foreign accounts for investment
Or other purposes is called the remittance. And if your remittances
are more than 10 lakh rupees annually, then you will have to pay a 20% TCS, that is, tax collected at source. Now, this can also help you to avoid paying advance tax. Look, you can share the TCS document or Form 12BAA with your employer to offset the TDS or the tax deducted at source. And this brings us to the last section of this video, that is planning taxes. In this section, we will learn to implement whatever we discussed in this video to reduce our tax liability. Unless you fall below 20% tax slab or your income from short-term trades is high enough to make up for the extra tax you'll pay, it usually makes more sense to stay invested for the long term. That is, if your primary goal is to reduce your overall tax burden. That's because short-term capital gains from US stocks are taxed at your slab rate. But under the new regime, your long-term capital gains are taxed at just 12.5%. Next, let's talk about dividends. Any dividends you earn from the US stocks are subject to a 25% withholding tax right there in the US. But here's where the Double Taxation Avoidance Agreement or DTAA comes in. You still have to declare that dividend income in India and pay tax as per your slab. But you can claim credit for the tax you already paid in the US. So you are not taxed twice on the same money and maintaining clear books. This will help you track your gains and losses so you can offset losses against gains and reduce your taxable income. For example, you made 1 lakh rupees in profit this year from your investment in the US market but made a loss of 50,000 rupees in the previous year. Now, although your taxable income for this year is supposed to be 1 lakh rupees. But since in the previous year you incurred a loss of 50,000 rupees, you can offset it against your taxable income, which means your effective taxable income is only 50,000 rupees. So that's how you can plan your taxes better. I hope this video will help you in maximizing your profits and reduce unnecessary tax burdens. Also, we recommend investing as per your risk appetite and always doing the due diligence before investing your money in any asset. So that's all from this video. Now, if you have any doubts regarding tax implications and US investments, feel free to drop a comment. And if you found this video helpful, don't forget to hit the subscribe button.